You are listening to chartingwealth.com. Today we have a training for you on inverse ETFs, making money when markets crash. Let's talk first about what an inverse ETF is, because you hear us mention it on the show all the time. Well, it's a type of exchange-traded fund that's constructed using varied derivatives, and we can get into that a little bit more later, that allow investors to profit from the decline of the underlying benchmark or security. Now, when we typically talk about them, we talk about, well, up to 4 different kinds, but usually it's 3. It's usually the S&P 500. We always track SPY. The inverse of SPY, which represents the Standard & Poor 500, is SH, or Sierra Hotel, for those of you who want to hear it phonetically if you're writing this down and listening only on audio. It is an inverse fund that tracks percentage in the opposite direction of the way the S&P 500 is moving. So if the S&P 500 is moving up, SH is moving down. If, however, markets are crashing and burning and the S&P 500 is moving down, SH is consequently moving up, and they attempt always to track percent to percent, unless it's a leverage type fund, and we'll talk about a couple of those in just a minute. Now, let's continue to sort of get into a little bit of the nitty-gritty. We're not going to make it too complicated, but what I want you to understand primarily is the greatest advantage that's offered by an ETF is that an investor is not required to hold a margin account. You've heard people talk about shorting the market. Well, the problem, and let me just explain to you what shorting means. A lot of folks hear that word, I'm going short, I'm going long. This is the way it used to work years ago, before we had all the different options, vehicles, the derivatives that we have now. If you wanted to short a stock, this is what you did. You would go to a brokerage house and you would say, I would like to short IBM. And what would basically happen is you would be charged so much by someone, and you'd have to have money in a margin account to cover losses. And those losses could actually be unlimited. And what would happen is you would borrow the stock and it would be sold. And then you would hope that the stock would go down so you could buy it back at a lower price and return it at the end of the period that you borrowed it for. You'd have to pay a price to borrow it, and then you would have to agree to return it. Now, of course, if the stock soared, it could just keep soaring in price and your losses would go up, 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 up. Well, that is the danger of shorting a market, and people still do that. But there's also the ability to use other vehicles now, options again, which you can lose the entire amount that you've invested in the option. But if you truly go short, if you go naked short, you can literally lose everything. So the beautiful thing about these inverse funds is, yes, you can lose the money potentially that you put into the inverse fund. It can potentially go to zero, but you're not going to be held to the tune of owing thousands or millions of dollars. So it doesn't end up putting you in a situation where you have to have a margin account, and you could end up risking unlimited amounts of money with short selling. So an inverse ETF seeks to perform opposite their benchmarks, like we were just talking about. Now, the example that I gave you with SH is one, and it attempts to move, again, like I said, percentage to percentage in the opposite direction of the S&P 500. In fact, the day that I made a couple of charts up, for those who are actually looking online, watching this via video, the S&P 500 actually was that day, it closed at, the SPY closed at $199.60, so $199.60. It was down $3.53. SH closed at 41.65, so $41.65. It was up 71 cents. And you might say, well, wait a minute, what's the percentage? Well, you compare the percentage, because the S&P, the SPY sells for a lot more than SH, but percentage-wise, The S&P 500 was down 1.74%. SH was up 1.73%. So they get really close on these. Of course, the volume in SPY was 439,988,666. The volume in SH was only 10,147,506. So we're talking 10 million versus almost 149 million. So the volume in the standard ETF is typically substantially more. So inverse ETFs are particularly popular investment vehicles, as you can imagine, in bear markets. Now, there's a few cautions that I want to give you. When you're investing in an exchange-traded fund, you have to make sure that it's simply a one-to-one short, unless you mean to do otherwise. For example, QQQ, which we talk about every single day, it's the NASDAQ 100. Well, QQQ actually represents the NASDAQ 100 on a daily basis, trades at a huge volume. The last one that we recorded was around 50 million shares a day. And there is an inverse fund that moves in the opposite direction of the Qs of the NASDAQ 100. It's called PSQ. So it's a one-to-one inverse fund. And the example that we give, it shows that QQQ was down 1.98%. Well, for the same day, PSQ was up 1.96%. So it's about a 0.2% difference. But what's really interesting is there is another fund called QID that is a leveraged inverse fund. What does that mean? Well, it moves at twice the speed. So it's a 2-to-1. So in other words, when the Qs goes down 2%, it goes up 4%. When it goes down 1%, of course, it goes up 2%. So it is literally a double inverse fund. So you have to be careful, making sure that you understand when you put your money into something like QID, that's a double inverse fund, it is going to move substantially quicker, which means your losses, if you invest wrong and the market turns against you, will be double what they otherwise would be in just a single inverse fund, just a standard inverse fund. So be aware of that. Now, since inverse ETFs have to be actively managed, they typically do have higher expense ratios than standard index ETFs, and the costs over time can eat away at your profits. It's important to realize that inverse ETFs are designed for relatively, and I use that term, I want you to keep that in mind, relatively short-term investing with market timing strategies, which is what we try to do. We try to follow the market. We try to time it. That's why we study the charts. And why is that? Well, it gets a little complicated, as I sort of mentioned earlier, but all ETFs, and that actually all inverse ETFs by nature are leveraged, and they have to sell when the market falls, and they have to purchase when the market rises. So a fixed leveraged ratio can be maintained. That's how they have to do it. Now the result, however, is a volatility loss that's consistent with the market variance that's occurring at the time. And that places the investor in a constant leverage trap. Now, you just have to realize, again, with all that said, relatively short-term investing. You're not putting your money long-term into these types of funds because of that constant leverage trap that you can find yourself in. So it just doesn't make sense to do in the long term. Now, with those notes of caution, I want you to realize that inverse ETFs can be used. And again, you get good at reading these charts, for relatively short-term times when the market drops. They can be very effective vehicles to help you get into the market and make money when everyone else is fleeing the market. And when you start reading charts, you will hear from a number of folks who get good at doing this that, wow, I have been able to do my virtual trades and make so much more money when the market's actually in a bearish position and going down than actually when it was going up. So again, everybody's different, but I hear more and more of that. Now you also have to realize that, you know, we always want to look for a bear market. Now you might say, well, does the whole market have to be a bear market? Well, here's the reason that at Charting Wealth we actually do our weekly review and forecast every week. And what do we talk about? Well, we talk about a lot of things, but particularly we talk about the weekly charts. Why do we do that once a week? We don't want to focus on it all the time. We just need to look at it once a week. But our weekly charts can help us understand what the big wave is doing. And if there is a big bearish wave that's taking place, the market is rolling over and going down, we know that the markets tend to move in the direction of the biggest wave because that's where things are going. You may have an uptick or so, but until that wave is vanquished, until the smaller waves get so powerful that they're able to move that big wave in the opposite direction, everything tends to go in the direction of the big wave. Hence, when we talk about where the markets are on that big wave, that weekly wave, you need to keep that in the back of your mind. Put that on your little charting notebook and pay attention that that is where the tendency of the market is to go. And once it goes bearish, okay, and when things roll over and start going in that same direction, that is where the sentiment is, okay? The sentiment, when it becomes bearish, again, is the time for you to start looking more and more to doing your practice trades with vehicles like QID or PSQ or SH. Now, gold also offers inverse funds. DGZ, that's Delta Golf Zulu. That is an inverse fund, 1-to-1 difference with gold. Also, and GLD, of course, is the index that we use to track gold at 1/10 of its movement. GLL is a leveraged inverse fund. So keep those three funds in mind. GLD, which is the underlying benchmark, DGZ, Delta Golf Zulu, and GLL, Golf Lima Lima, for all of you military folks like me out there. Now again, knowing the weekly waves and where the market is should always be in the back of your mind. Now lastly, before purchasing any stock, any ETF, any option, and again, we're not, I'd always give this caveat, we are not presenting you with trading advice. We're an education firm. We're trying to educate you on how to read charts. Once you get good at this, you can make your own decisions, spend your money any way you want to. You can go to Vegas and gamble it all away. But hopefully you won't do that. And hopefully you won't do that with the market. You'll learn to read this. You'll get good at it. You'll develop your own way of doing things in your own pace. You'll take what we teach you, use what helps, and discard what doesn't, and make up your own mind and come up with your own way of trading. But you need to know and understand the liquidity of a security. Now, what is liquidity? Well, we've got a great podcast on liquidity. I urge you to go and watch that. But for an example, let's look at the Qs, the NASDAQ 100. We have an example where the the bid price for the Qs is 102.23. The ask is 102.33. So there's about a 10% difference for every share that you want to buy. That is a quite liquid asset. In other words, for 10 cents, you can buy it. And again, always remember, you always buy at the highest price. You always sell at the lowest price. So you can buy the Qs at $102.33. You can immediately turn around and sell it and take a 10-cent loss on something that cost you over $100. Now, that is highly liquid. Means that if you jump in and the market moves against you, you can jump out real quick with very little loss. That's very liquid. Not as liquid as a dollar bill that has 100% liquidity, You get a dollar bill, you can turn around and give it right away, and it works the same each way. But you buy a house, it can take you weeks to sell it, and you could lose tens of thousands or hundreds of thousands or millions of dollars. Not a very liquid asset. The Qs is. Now, something like PSQ, which is the inverse of the Qs, its opening price was, its bid price was $54.55. There is no ask price listed here. Again, that's just because the time frame that we actually shot this. If we look at QID, which again trades at about 6 million versus 2 million a day of the PSQ versus 50 million a day of the Qs. If you look at QID, which is the double inverse of the NASDAQ 100, the bid was $32.39. The ask was $1 more. So in other words, it's going to cost you $1 if you immediately bought it and turned around and sold it. Actually, $1.02. So be aware that some of these leveraged funds do have a much higher price, a liquidity, that is to buy and get out. So you're going to need to make $1 just in the cost to buy and sell it in order to even break even. So again, be aware of that. Always look at the liquidity of everything that you buy and sell, whether it's an option, whether it's an ETF, whether it's a stock. Be very much aware of that. But in markets that are crashing, in markets that are moving down substantially, when you get good at being able to read stock charts, it is going to make a lot of sense for you to consider these options. And as you are getting good at this and as you are practicing, I very much encourage you to look at these inverse ETFs. Be willing to jump in there and experiment. What does it cost you? I mean, you're dealing with virtual dollars in your virtual trading account. So you can make mistakes and it doesn't cost you anything. Maybe a little bit of pride, but again, be willing to sacrifice your pride in order to learn, because that's all you're sacrificing here. You're not sacrificing your money doing this practicing and this virtual trading. Thank you so much. We appreciate you being with us. If you have questions, concerns, things we can make more clear, I'll be happy to add to, redo, whatever we need to do with this podcast to make sure that it's everything you need it to be. We so appreciate you at chartingwealth.com. Let us hear from you. Go to the website, subscribe to our daily newsletter, and also go to iTunes. Listen to us. If you really like what we do, give us a good 5-star rating there. Thanks so much. God bless you. We're glad to bring you this from chartingwealth.com.